Gold, silver, and the Federal Reserve. 3 words, 1 collision course. What if everything the financial world believed about normal was never coming back? Today is not just another rate decision. It is a trap door, and most people are standing right on top of it. The bond market is bending. The currency is bleeding. And the metals? They're whispering something that the headlines refuse to say out loud. By the end of this video, you will understand exactly what is coming next. But here is the question. Will you be ready when the door opens? Welcome to Boring Currency Analysis, where the truth is not exciting, but it might just save your portfolio. Now a small request. You've been around long enough to know that good information does not shout, it whispers. And if these whispers have helped you think clearer even once, then do this old-fashioned thing called subscribing. Just 1 click. So the algorithm does not decide what you see next. You do. And before we dive in, drop a comment. Tell me, where are you watching from right now? New York, London, Dubai, Karachi? Let us see how far this conversation travels today. Now let us begin. Most people woke up today thinking this was just another Federal Reserve decision day, another headline, another talking head explaining whether rates go up or down. But something feels different this time. The air is heavier, the numbers are stranger, and the people who actually move money for a living are not acting the way they usually act. This is not about a quarter point anymore. This is about a direction, a shift, a turn that most people will not recognize until they are already on the wrong side of it. Think about what the central bank is being asked to do right now. Cool down inflation that people can still feel every time they buy groceries. Keep the economy from cracking under pressure. And somehow protect the bond market like it is made of glass. That is not 2 things. That is 3 impossible things at the same time. And when any institution tries to do 3 impossible things at once, something has to break. The language coming out of policy meetings has changed. Listen carefully and you can hear it. A year ago, the tone was confidence. We are fighting inflation. We have the tools. We will win. Now the tone is different. Now the words sound like someone trying to convince themselves that everything is still under control. That is not strength. That is fatigue. And fatigue leads to mistakes. Here's what most people miss. The biggest errors were not made last month or last year. They were made over a decade ago when emergency settings became permanent settings, when interest rates were held so low for so long that an entire generation forgot what normal even looks like, when debt stopped being a temporary tool and became the entire strategy for running the economy. Think about the pattern that has repeated again and again. A crisis hits, rates get slashed to 0, markets celebrate. Everyone feels rich for a while. Then the hangover arrives, inflation, bubbles, instability. So what is the solution? More of the same medicine. Lower rates, more liquidity, more debt. And every single cycle leaves the patient weaker than before. This is not politics. This is just how incentives work. When the easiest solution is always to print more and borrow more, that is exactly what happens. Until one day, the easy solution stops working. Now ask yourself a simple question. What happens if they start cutting rates while inflation is still the kind of inflation you can feel in your daily life? The answer is pressure. Pressure on the currency. Pressure on confidence. Pressure on the entire system that depends on people believing the dollar is still the safest place to be. And this is where gold and silver enter the story. Not as speculation, not as a get-rich-quick trade, but as a signal, a measurement of something deeper. When metals start moving in ways that do not match the daily headlines, it usually means the market is sniffing out a story that has not been told yet. Over the last few weeks, that movement has been hard to ignore. And yes, metals can be volatile. They can pull back. They can scare people out of positions. But when the big picture is shifting, the pullback is not the story. The new floor is the story. Here's the question that matters. Is the world still operating in the old system where the dollar is the unquestioned anchor of everything? Or is there a slow slide happening towards something else? Because if that anchor moves even slightly, the price tags on everything in your life move with it. Most people are watching the wrong screen. They're staring at the headline, waiting to see if the Fed cuts or holds. But the real story is not in the headline. It is hiding in the corners. The currency charts, the long end of the yield curve, the strange behavior of metals that are supposed to be boring. And there is one place where the panic always shows up first. Before it hits your stocks, before it hits your savings, before any talking head admits that something changed, that place is quiet. It is technical. Most people find it boring, but it is the loudest alarm bell the financial system has. What is that place? And what is it saying right now? That answer comes next. There's a part of the financial system that nobody talks about at dinner parties. It does not trend on social media. It does not have a logo or a mascot. But every single dollar you earn, every mortgage you pay, every business loan that gets approved, all of it flows through this one thing, the bond market. Think of it as the spine of the entire economy. When the spine is healthy, everything else moves smoothly. But when the spine starts bending in ways it should not bend, the whole body begins to feel the pain. Right now, that spine is under pressure that most people cannot see, and the pressure is coming from two directions at once. On one side, policymakers want to cut short-term rates. They want to make borrowing easier. They want to calm the headlines and keep the economic machine running. But on the other side, long-term rates are doing something different. They're creeping upward, slowly, quietly, like a tide coming in while everyone is looking the other way. This creates a problem that does not have an easy solution. When short rates fall and long rates rise, you get a tug of war. And tug of wars in financial markets do not end politely. Someone always loses their grip. Here's why this matters to you. Long-term yields are not just numbers on a screen. They are the price of the future. They tell you what $1 today will be worth 10 years from now. They set the cost of every mortgage, every car loan, every corporate expansion plan. When long-term yields rise, the cost of everything that depends on borrowing goes up with them. But there is something deeper happening beneath the surface, something that connects the bond market to the metals market in a way that most people never consider. It starts with confidence. When investors believe that inflation will stay controlled, they accept lower yields. They trust that their money will hold its value. But when that trust begins to crack, they demand more. More yield, more compensation, more protection against the slow erosion of purchasing power. And here is where the loop begins. When confidence weakens, lenders charge more to lend. When lenders charge more, the cost of servicing existing debt rises. When debt service rises, governments face pressure to do something. And when governments do something, that something almost always involves creating more money chasing the same goods, more currency units competing for the same value, and the currency pays the price. This loop has a name among people who study these things. They call it the confidence spiral. And once it starts turning, it is very difficult to stop. Now here's the part that makes gold interesting. Gold does not care about speeches. It does not care about press conferences or policy statements. Gold responds to one thing and one thing only: the behavior of the system around it. When real interest rates are high, gold struggles. Why hold something that pays nothing when you can hold something that pays 5%? But when real rates drift toward zero or go negative, the math changes completely. Suddenly, the thing that pays nothing is not losing ground anymore. It is holding its ground while everything else sinks. This is why gold can rise even when the headlines say the economy is fine. Because gold is not measuring the economy. Gold is measuring the confidence behind the economy. It is measuring whether the people who move serious money believe the promises being made. And right now, gold is moving in a way that suggests those people are not entirely convinced. But here is where most investors get confused. They look at the price of gold and they ask the wrong question. They ask, where's the top? As if there is one magic number where the story ends. There is no single top. There are two completely different numbers. One is the trading number, the short-term zone where momentum cools and profits get taken. That number changes every week based on sentiment and positioning. Yet the other number is much bigger. It is the monetary number, the level that would make sense if gold were being revalued as a serious anchor in a world drowning in debt. Those two numbers are not the same, and confusing them is how people make decisions they later regret. The trading number is for speculators. The monetary number is for people thinking in decades. Which number are you watching? There is a metal that sits in the shadow of gold. It does not get the same respect. It does not get the same headlines. For decades, serious investors looked at it and saw something too volatile, too unpredictable, too wild to trust. That metal is silver. And right now, silver is doing something that is making even the skeptics pay attention. To understand why, you have to forget everything you think you know about how commodities work. Because silver does not follow the normal rules. It lives in two worlds at the same time. One foot in the monetary world, where it has been used as money for thousands of years. One foot in the industrial world, where it is buried inside almost every piece of technology you touch. This dual identity is what makes silver behave in ways that confuse people. It can sit quietly for years, doing nothing, boring everyone who owns it. Then suddenly it wakes up and moves faster than almost anything else in the market. The question is why? Why now? Why this moment? The answer begins underground, in mines scattered across the world where silver is pulled from the earth. But here's the strange part. Most silver is not mined because someone wanted silver. It comes out of the ground as a byproduct of mining other metals: copper, lead, zinc. The silver just happens to be there, mixed in with the ore. This creates a supply problem that most people do not understand. When the price of silver doubles, you do not get double the silver. The supply depends on how much of those other metals are being mined. And mining companies do not build new operations overnight. It takes years of exploration, years of permitting, years of construction. By the time new supply comes online, the market has already moved. Now add the demand side to this equation. Silver is threaded into modern life in ways that are invisible to most people. It is inside solar panels, inside electric vehicles, inside the servers that run every data center powering the internet, inside medical equipment, inside advanced electronics. Small amounts per device, yes, but multiply those small amounts by billions of devices and the numbers become very large. The world is building more solar capacity than ever before. The world is building more data centers than ever before. The world is electrifying transportation faster than ever before. All of this requires conductive materials. And silver is one of the most conductive materials on the planet. So you have a situation where demand is rising from sources that did not exist 20 years ago. And supply cannot respond quickly because of the way silver is actually produced. This is not a temporary imbalance. This is a structural constraint built into the way the metal reaches the market. But there is another layer to this story that most analysts ignore. Governments are starting to pay attention to critical materials in ways they never did before. Resource nationalism is rising. Countries do not want to ship out strategic inputs for cheap and then buy back finished products at premium prices. They want to control what leaves their borders. When a metal gets labeled as strategically important, the rules change. Export restrictions appear. Stockpiling begins. Supply that was once freely traded becomes political. And markets that assumed everything would always flow smoothly suddenly discover that assumptions can be expensive. Now here is the part that reveals where the smart money stands. Watch the mining stocks. When metal prices rise, mining companies should rise with them. Their profits should expand. Their valuations should follow. But sometimes that does not happen. Sometimes the metal runs higher while the mining stocks lag behind. That gap tells you something important. It tells you that investors do not trust the move. They think the metal will snap back down. They think margins will not hold. They are waiting to be proven wrong. And that doubt is fuel. Because when the skeptics finally capitulate, when they finally accept that the move is real, their buying becomes the next leg higher. The last group to believe is often the group that pushes prices furthest. Silver is the wild metal. It rewards patience and punishes impatience in equal measure. It can make you look like a genius one month and a fool the next. But beneath all that volatility, something structural is shifting. Something that has nothing to do with short-term charts or daily headlines. What exactly is shifting? And what does it mean for everything else in your portfolio? That answer is closer than you think. There's a fantasy that lives in the minds of people who watch markets. The fantasy goes like this. One day, a new leader will arrive, a tough voice, a steady hand, someone who will finally restore order, fix the system, and bring back the world that made sense. This fantasy is dangerous, not because strong leaders do not matter. They do. But because no single person can reverse a machine that has been running in one direction for decades. The incentives are too deep, the debts are too large, the political pressure is too constant. If the economy slows and debt costs rise, the demand from every corner of society will be the same. Relief, lower rates, easier money, more liquidity. Whoever sits in the chair will face that pressure every single day. And pressure has a way of winning. So waiting for a hero is not a strategy. Waiting for someone to fix the system is not a plan. The only plan that works is building a position that does not depend on the system being fixed. This brings us to the question that every serious investor eventually has to answer. What does a portfolio look like when the old rules stop working? For decades, the answer was simple. Stocks for growth, bonds for safety, put them together, and you have a balanced portfolio that can weather any storm. This idea worked beautifully when inflation was low, when rates were falling, and when bonds actually went up, when stocks went down. But what happens when that relationship breaks? What happens when inflation stays uncomfortable, when bonds lose value alongside stocks, when the safety leg of the portfolio stops providing safety? And the answer is that investors start looking for a different anchor, something that does not depend on interest payments, something that does not have counterparty risk, something that exists outside the system of promises and obligations. Not everyone chooses metals, but enough people choosing metals, even as a small percentage of very large portfolios, can move a market that is tiny compared to global stocks and global bonds. That is why metals can surprise people. The flows do not have to be large in absolute terms. They just have to be large relative to the available supply. Now here's the practical question. How does someone actually position for this kind of environment? The first step is to stop thinking like a trader. Most people do not need perfect entries. They need a plan that survives stress. The market exists to mess with emotions. Fear and greed take turns running the show. The only defense is a plan made before the chaos arrives. The second step is to think in terms of allocation. Not all in, not all out. What percentage of total wealth belongs in assets designed to protect purchasing power? That is a personal decision. But it is a decision that should be made calmly before the next wave of headlines tries to make it for you. The third step is to accept volatility. Silver especially moves like a wild animal. It can feel like a mistake for weeks at a time. It can test patience in ways that other assets do not. Choosing silver means choosing the swings. There's no calm version of that trade. But beyond the metals themselves, there is something else to watch. Something that most people ignore because it seems boring. The plumbing of the system, the small rule changes, the quiet adjustments to how liquidity is provided, the policies labeled temporary that somehow never go away. Big changes in financial systems rarely arrive with announcements. They arrive through the back door. A tweak here, an exception there. A facility that was supposed to last 6 months still running 5 years later. These are the signals that tell you the ground is shifting beneath your feet. The Federal Reserve decision today is not the end of any story. It is a page turn, one chapter closing and another opening. The words spoken at the press conference matter less than the direction they reveal. And the direction right now is pointing toward more support, more liquidity, and more currency creation. Whenever the system shows signs of stress, that direction has consequences. For the dollar, for bonds, for the price of everything measured in dollars, and for the metals that have served as an outside anchor for thousands of years. The trapdoor is not a metaphor. It is a mechanical reality built into a system that requires constant expansion to avoid contraction. Most people will not see it open until they are already falling. But you're not most people. You're still here, still watching, still thinking. And that is the only edge that matters.